Friday, January 31st, 2026. Silver, 98.66 per ounce, down 15%, crashed below the psychological $100 barrier. Gold, down 7%, silver futures, down 11%, platinum, down 14%, palladium, down 12%. But the real carnage wasn't in the metals themselves. It was in the stocks and funds tied to them. Fresnillo, the world's biggest silver producer, down 7%. Endeavour Silver, down 14.7%. First Majestic Silver, down 14.4%. The ProShares Ultra Silver ETF, down 25% in pre-market trading, before most Americans even had their morning coffee. Europe's mining index, down 3.2%. Silver ETFs getting demolished, gold miners following suit, and spreading across global markets like a contagion. This wasn't just precious metals correcting after a parabolic rally. This was a full-scale unraveling of one of the most crowded trades in modern financial history. A violent unwinding that exposed how fragile markets become when everyone believes the same story. Today, we're dissecting the mining stock massacre, exposing why leverage in ETFs turned a 15% metal decline into a 25% fund collapse, revealing what concentration risk really means when the trade unwinds, and explaining why this might be the most important market lesson of 2026 so far. The cascade, how $98 silver destroyed everything. Let's start with the domino effect, because understanding the sequence matters. Domino 1. Silver crashes spot. Silver plunged 15% to $98.66 per ounce by 5:04 a.m. ET. This broke below the critical $100 psychological level, triggering algorithmic selling and stop-loss orders. Domino 2. Futures amplify the move. Silver futures for February delivery fell 11%. Gold futures in New York dropped 5.5%. The futures markets, which are more leveraged than spot markets, experienced slightly different but equally violent moves. Domino 3. Other precious metals follow. Platinum crashed over 14%. Palladium fell nearly 12%. The entire precious metals complex was selling off in unison, suggesting this wasn't about silver specifically. It was about unwinding positions across the board. Domino 4. Mining stocks get annihilated. Fresnillo, the world's largest silver producer listed in London, fell 7%. Endeavour Silver dropped 14.7% in pre-market U.S. trading. First Majestic Silver lost 14.4%. Notice something. The mining stocks fell as much or more than the underlying metals. This is leverage at work. When the commodity falls 15%, stocks of companies that mine that commodity can easily fall 20-30% because of operational leverage. Domino 5. ETFs experience amplified destruction. The ProShares Ultra Silver Fund collapsed 25% in pre-market trading. The iShares Silver Trust ETF dropped 12.7%. This is where it gets dangerous. A 2x leveraged ETF like ProShares Ultra Silver is designed to deliver twice the daily return of silver. When silver falls 11% futures, a 2x ETF falls roughly 22%. Add in panic selling, widening bid-ask spreads, and liquidity issues, and you get 25%. Domino 6. Broader market contagion. Europe's Stoxx 600 Basic Resources Index, which includes the continent's most valuable mining companies, fell 3.2%. The sell-off wasn't contained to silver. It spread to the entire mining sector, then to broader resource stocks. This is a cascade. Silver, futures, other metals, mining stocks, leveraged ETFs, sector indices, market contagion. Each step amplifies the move. By the time you get to leveraged ETFs, a 15% decline in the underlying metal has turned into a 25% wipeout. The leveraged ETF death trap. Let's zoom in on ProShares Ultra Silver losing 25% because this reveals something crucial about how these products work and why they're dangerous. ProShares Ultra Silver is a 2x leveraged ETF. It uses financial derivatives and debt to amplify silver's daily moves. If silver goes up 5% today, the ETF aims to go up 10%. If silver falls 5%, the ETF falls 10%. This sounds great during a rally. Silver surges 56% in a month. A 2x ETF would theoretically deliver 112% returns. But here's the catch. Leverage works both ways, and it compounds in devastating ways during volatility. The math of destruction. Let's say you bought ProShares Ultra Silver at $50 when silver was at $115. Silver falls from $115 to $98.66. That's a decline of roughly 14.2%. A 2x leveraged ETF should fall about 28.4%. But Friday, it fell 25%. Why not 28.4%? Because leveraged ETFs experience decay during volatility. The daily rebalancing required to maintain 2x exposure creates mathematical drag. In volatile, choppy markets, leveraged ETFs underperform even their stated leverage ratio. Here's the killer. If you held through the volatility and silver eventually recovers to 115, your 2x ETF won't fully recover. You've permanently lost value due to volatility decay. This is why leveraged ETFs are trading vehicles, not investments. They're designed for daily moves, not buy and hold. Friday exposed thousands of retail investors who didn't understand this. They thought they were getting double the gains on silver's rally. Instead, they got double the losses plus volatility decay. The mining stock leverage multiplier. Now let's talk about why mining stocks fell harder than the metals themselves. Fresnillo fell 7% while silver fell 15%. Wait, shouldn't the stock fall less than the commodity? It's a diversified company with multiple operations, right? No. Mining stocks have operational leverage that works against you during commodity price declines. Here's how it works. Fixed costs dominate. Mines have massive fixed costs: labor, equipment, energy, infrastructure. These don't change when metal prices fall. Profit margins compress violently. When silver is at $120 and it costs $70 to mine an ounce, the profit is $50 per ounce. When silver falls to $98, the profit is $28 per ounce. That's a 44% decline in profit per ounce from an 18% decline in price. Valuation multiples contract. Stocks don't trade on revenue. They trade on earnings and future cash flow projections. When commodity prices fall, analysts slash earnings forecasts, which compresses valuation multiples. Debt concerns emerge. Many mining companies carry significant debt. When commodity prices fall, debt servicing becomes harder, raising bankruptcy concerns and credit risk. Production hedging losses. Some miners use derivatives to hedge future production. When prices fall suddenly, these hedges can create mark-to-market losses that hit quarterly earnings. This is why Endeavour Silver fell 14.7% when silver fell 15%. It's not just the metal price, it's the cascade effect through the entire business model. And for investors holding mining stocks thinking they were getting leveraged exposure to silver's upside, they got exactly that. Leverage cuts both ways. The concentration risk reckoning. Katie Stoves from Mattioli Woods nailed the core problem. When everyone is leaning the same way, even good assets can sell off as positions get unwound. This is concentration risk, and it's one of the most dangerous forces in modern markets. Here's what happened. For months, precious metals were the trade. Every hedge fund, family office, retail trader, and institutional investor piled in. The narrative was compelling. Geopolitical chaos, Venezuela, Greenland, Iran, dollar weakness, Fed uncertainty, inflation fears, central bank buying, safe haven demand. It all made sense. The fundamentals were strong. The story was clear. So capital flooded in. Not just some capital, massive, concentrated flows. Stoves draws a parallel to AI tech stocks. Just as tech stocks, particularly AI-related names, have dominated market attention and capital flows, gold has similarly seen intense positioning and crowding. This is the setup for disaster. When a trade becomes too crowded, any shock triggers a stampede for the exits. The problem: everyone wants to sell at once. But who's buying? Answer: nobody. Or at least, not at current prices. So prices gap down violently, as sellers desperately hunt for buyers. The more concentrated the positioning, the more violent the unwind. Friday was that unwind. It wasn't about fundamentals changing. It was about too many people holding the same position and racing to exit simultaneously. The Day of Reckoning Stoves uses a powerful phrase. Concentrated positions eventually face their day of reckoning. This is a market truth. that new investors learn painfully and experienced investors never forget. It doesn't matter if the asset is good. It doesn't matter if the fundamentals are strong. When positioning becomes too concentrated, the unwind is inevitable and brutal. We saw this with the dot-com bubble in 2000, housing in 2008, FANG stocks in late 2022, meme stocks in 2021, crypto in 2022, and now precious metals in 2026. The pattern is always the same. Strong fundamentals create a compelling narrative, capital floods in, creating a self-reinforcing rally. Positioning becomes extremely concentrated. Some catalyst, often minor, triggers the first wave of selling. Selling begets more selling as leveraged positions get liquidated. Panic sets in, and the concentrated trade unwinds violently. Friday was stage 5 to 6. The catalyst was Trump's Fed chair announcement speculation. But the real cause was concentration risk that had been building for months. Central bank buying, the support that disappeared. Tony Meadows from BRI Wealth Management points to something crucial. Central bank buying has driven the longer-term rally, but this has tailed off in recent months. This is a fundamental shift that many gold bulls are ignoring. For years, central banks worldwide, particularly China, Russia, India, Turkey, and Poland, were aggressive net buyers of gold. This created a one-way bid under the market, constant buying pressure with limited selling. But if that buying has tailed off, the market dynamics change completely. Without central bank buying to absorb selling pressure, retail and institutional flows have to carry the weight. And retail institutional flows are fickle, driven by momentum and sentiment rather than strategic long-term allocation. Meadows still sees potential for future central bank buying. The case for further reserve diversification is still there, though as Trump's trade policies and intervention in foreign affairs will make a lot of countries nervous about holding U.S. assets. But still there is different from actively happening. Markets trade on what's happening now, not what might happen eventually. If central bank buying has genuinely slowed, one of the key pillars supporting gold's rally has been removed. The dollar stabilization. Meadows also highlights another critical factor. The dollar has stabilized. For weeks, the dollar was in freefall, hitting multi-year lows. This was rocket fuel for gold and silver because cheaper for international buyers. When the dollar falls, commodities priced in dollars become cheaper for buyers using euros, yen, yuan, etc. Inflation hedge demand. Dollar weakness signals loss of confidence in the reserve currency, driving safe haven flows to gold. Carry trade dynamics. A weak dollar encourages borrowing in dollars to buy commodities, amplifying the rally. But when the dollar stabilizes or rebounds, all of this reverses. Friday, the dollar strengthened on speculation that Kevin Warsh would bring hawkish monetary policy. Even if the dollar didn't spike dramatically, the stabilization was enough to remove a key driver of the metals rally. Meadows argues gold got to $5,000 too easily, implying the rally lacked genuine resistance and was driven more by momentum than sustainable demand. When easy rallies reverse, the unwinding is equally easy, which is to say, brutally fast. The perfect storm that turned into a perfect disaster. Claudio Wevel from Safra describes the setup perfectly. A perfect storm of geopolitical tensions drove precious metals higher. U.S. capture of Venezuelan President Maduro, escalating tensions in Latin America. Washington's threats on Greenland. Bizarre but real geopolitical uncertainty. Iran military force threats. Middle East instability. All of this fed the narrative that the world was becoming more dangerous and unstable, driving safe haven demand for gold and silver. But Wevel points out the shift. The market has clearly been pricing the risk of a much more dovish contender for Fed chair. That's been largely helping the gold price along with other precious metal prices. Over the last 24 hours, the news flow has changed a little bit. This is the crucial insight. The geopolitical perfect storm is still there. Maduro is still captured. Greenland threats still happened. Iran tensions persist. But the Fed chair speculation changed the calculus. Markets started pricing in higher rates, tighter policy, and a stronger dollar. Suddenly, the geopolitical risks that were driving gold higher became secondary to monetary policy expectations. This reveals something uncomfortable. Gold's rally wasn't primarily driven by geopolitical fear. It was driven by monetary policy expectations and dollar weakness. When those expectations flipped, geopolitical tensions didn't matter anymore. The trade unwound. The 2025 rally that set up 2026's crash. Let's zoom out to appreciate how spectacular the rally was before the crash. In 2025, gold surged 65%, silver skyrocketed 150%. Think about what 150% means for silver. If you bought silver at $40 at the start of 2025, you sold at $100 by year-end. You more than doubled your money in 12 months. That's not normal for a commodity. That's cryptocurrency-level volatility. And 2026 started where 2025 left off. Silver added another 37% year-to-date before Friday's crash. Gold was up 15.4%. So in roughly 13 months total, silver had gone from maybe $40 to peak at $121. That's a 200% plus gain. Gold went from around $3,000 to $5,594, an 86% gain. These aren't sustainable moves, they're parabolic, and parabolic moves always end the same way, violently. The 2025 rally created the conditions for 2026's crash. The higher metals rose, the more leverage built up, the more concentrated positioning became, the more vulnerable the market was to any reversal. Friday was the reversal, and the violence matched the parabolic nature of the rally. What happens to mining stocks? Now, so where do mining stocks go from here? They're in a uniquely difficult position. If metals stabilize, mining stocks could recover partially, but they'll likely underperform the metals themselves on the way back up. Operational leverage works both ways, but market sentiment toward miners deteriorates after crashes. If metals continue falling, mining stocks get destroyed. Some smaller miners could face bankruptcy if silver falls to $70, $80, or gold to $4,500. Debt servicing becomes impossible. If metals rally back, mining stocks would rally explosively, potentially outperforming the metals. But investors who got burned Friday will be hesitant to pile back in. The key is credibility. Mining stocks lost credibility Friday. Investors who thought they were getting smart exposure to metals through equities instead got leveraged volatility that destroyed portfolios. Rebuilding that credibility will take time. Even if gold rallies back to $5,600 next month, mining stocks might lag because burned investors have moved on. The ETF warning label. Friday should come with a warning label for every investor considering precious metals ETFs. Leveraged ETFs are not investments. They are daily trading vehicles. If you don't understand volatility decay, daily rebalancing, and compounding math, you have no business owning leveraged ETFs. A 25% loss in ProShares Ultra Silver, while the underlying metal fell only 11-15%, is not a bug. It's a feature. These products are designed to deliver 2x the daily return. Over longer periods, especially volatile ones, the math works against you. Friday was a 100 million plus lesson in reading the fine print. The bottom line, silver plunged 15% to 98.66. Gold fell 7%. Platinum crashed 14%. Palladium dropped 12%. But the real massacre was in the stocks and funds. Fresnillo, 7%. Endeavour Silver, 14.7%. First Majestic, 14.4%. ProShares Ultra Silver, 25%. iShares Silver Trust, 12.7%. Europe's mining index, 3.2%. This wasn't just a commodity correction. It was the violent unwinding of one of the most concentrated trades in recent memory. The 2025 rally, 65% for gold, 150% for silver, created the setup. Crowded positioning, excessive leverage, and concentration risk built to unsustainable levels. All it took was speculation about a hawkish Fed chair to trigger the cascade. Central bank buying has tailed off. The dollar has stabilized. The easy rally to $5,000 gold reversed into a violent sell-off. Leveraged ETFs amplified the pain, turning 15% metal declines into 25% fund collapses. Mining stocks got destroyed by operational leverage, falling as much or more than the metals themselves. The fundamentals, geopolitical chaos, fiscal concerns, haven't disappeared. But when concentration risk unwinds, fundamentals don't matter in the short term. Friday was the day of reckoning for concentrated positions. Even good assets sell off when everyone tries to exit at once. The lesson: popularity is risk. Crowded trades are dangerous. Leverage is a double-edged sword, and sometimes even safe havens aren't safe. If this helped you understand the cascade, hit that like button and tell me, are you staying away from leveraged ETFs now? This has been your guide to why concentration risk matters more than fundamentals. Thanks for watching, and I'll see you in the next one.